This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion.
So how you doing out there in COVID land, Corona land? I would have to say I'm doing pretty good. I have no complaints. I'm lucky that I don't have any friends or family that I know of who have died from Corona. But I do know somebody who died from Corona. He was a baseball coach of mine when I was younger. Great guy. Always gave me the best catcher's equipment. A guy named Glenn Cordell. When I was younger, I wasn't so good at first. And look, I was never a professional player or anything like that. But I was pretty damn good as a teenager. But at first, maybe some people did not believe in me. But this guy, Glenn, he always believed in me. Very quiet guy. And he just liked attitude as well. He liked that kind of like, go give him some shit attitude. So it did suck to see that he had passed from Corona. That was not cool. Not a good thing. He was an older guy, had some health problems, but still. So I know it's a damn bad time in the sense that everyone probably knows somebody, even if it's not, again, their close personal family, they probably know somebody in the distance of their life that they have had contact with at some point in time. But we also have to keep moving. I mean, if I flip on CNN right now, it's the most depressing thing I've ever seen. I mean, CNN is like, hey, go to your basement and hide. That's just not workable. We all know who is dying from this damn disease. It's older people with health problems. It's older people with obesity. It's not young, healthy people. Now, of course, young, healthy people can spread it to older, sick people. I get the whole thing. But we also have to think about what's going to happen to so many young people. And you can already see suicide rates going up. But we have to think about what's going to happen to young people if their economy sucks. Their life will suck. And then we really have to ask ourselves, shit, did we overdo it? So with all that said, let me change the tables on you. Let me flip the switch on you to something else. To put your mind to two prior guests of mine, Allison Gopnik and Jack Schwager. Allison, a psychologist, Bayesian Babies, one of my favorite episodes on this podcast ever. And Jack Schwager, perhaps the most all-time best-selling author in the investment space of anyone. I mean, I think that's true. I think it's Jack. Now, Allison has only been on this show one time. Jack has been on a bunch of times. I'm going back to Jack's very first appearance on this show. So please, sit back, change your mind from Corona, and enjoy the insights from these two very interesting and very smart people.
When I think back to my start of trying to get inside the mind of really good traders, in the early 90s, there was only really one place to start. And I remember picking up the book Market Wizards and reading it and thinking, I understand about half of this. Like it was deceptively dense. And I'm sure a lot of people can still go back and read Market Wizards and New Market Wizards and still not understand all the details because it's right there in front of you, but sometimes it's hard to get your arms around. So with that, and I don't think I'm the only person, I think that those books really affected an entire generation. I mean, those are still today. If you haven't read them and you want to try and make money in the markets, what's wrong with you? That's my question. So I'm lucky today to talk to the gentleman that wrote those books, Jack Schwager. And Jack has a new book out that I think anybody that liked the Market Wizards and like the New Market Wizards and like Stock Market Wizards, this one's called Hedge Fund Market Wizards. You're going to like it. I read it over the weekend. It raises all kinds of questions. It gets you thinking in the right way. And anyways, Jack, thank you for being here on the show today.
Hey, Mike, thanks for the introduction. Appreciate it.
Well, before we even get into some of the content and some of the specifics here, I think a lot of people would like to know, like, what makes Jack get up every morning? What makes you tick? Like, what's your daily grind?
Not terribly exciting. I kind of have a routine, no set routine to speak of. It depends what I'm doing at the time. So last couple of years, it was basically changed. I deliberately left my last day job and wanted to take some time to write a couple of books. The first one of which was Hedge Fund Market Wizards, and the other one which I just completed. So my grind is just varied from day to day. I'd write whenever I felt it was working, which was most of the time, I guess. And I take time breaks whenever I wanted to, whether it's take a walk or to do something else, but nothing terribly exciting.
Well, but you've built the life that you've wanted.
Yeah, what I basically have done for quite a number of, even my day job was a day job run from a home office and sort of working in conjunction with a London-based company. And even now, my other endeavor will be to be managing a portfolio, again, working as a consultant, not as a daytime job. So I've kind of managed to be working full time and be retired at the same time. So it works pretty well.
I think that's the dream everybody wants. That sounds that's the way to approach it. Well, let me get into your new work, because I think this is what people really want to know about. And for any of you folks out there that have looked at Jack's first three books, especially the first and second one, this book has got, this isn't a book of just semi good names in the trading space. It's like the guys. I mean, these are the people today in 2012 that are kicking royal tail on the markets are in Jack's new book. So as a fellow author who is in this space, I have to, there's a certain side of jealousy, of course, that these great interviews. But the thing that caught my eye, because I actually saw this interview on 60 Minutes. And so when I saw it in your book, Jack, I thought it was great. And I just want to kind of repeat this quote for a second. And it's a quote from a 60 Minutes episode with a rock climber named Alex Honnold. And Lara Logan asks him a question. He says, "Do you feel the adrenaline at all?" This guy would climb these sheer 1,000-foot cliffs, no ropes, no nothing. I mean, it's insane. If you haven't seen this on 60 Minutes, go see it. And Alex goes ahead and he says, "There is no adrenaline rush. If I get a rush, it means that something has gone horribly wrong. The whole thing should be pretty slow and controlled." Now, there's got to be a story as to why you opened your book with that. I love it. That's great. I mean, I want to steal it, but now I can't because you've already used it.
Well, I actually love that you picked that up. I spend a lot of time sometimes picking the right quotes for things, and usually people, and I had books I've written where I've had a quote for every chapter, and I spent a lot of time kind of getting the right quote. Nobody ever pays attention to it and so forth. And well, the reason I picked this one, and the reason I liked it so much, and of course I had no intention, I never even thought that when I was watching 60 Minutes and watching this story on this amazing solo climber, that it would lead to a quote that was relevant to the book. But when he said that, I said, that is really the epitome of trading. And it also flies in the face of what people think trading is all about. You mentioned trading to most people, and they say they have this picture of this adrenaline-filled room and people shouting orders, and it's all this tumult and emotion and aggressiveness and panic and all these things that people picture trading is about. And the irony of it is that the people who are really good at it, you walk into their rooms and it's like a library, and it's all carefully planned out. It's all controlled. There is no emotion. And that is really what a good trader is. I get one example trader I interviewed, and you mentioned I have some high-profile names. I also try to pick out people who no one knows. And one trader I interviewed for this book is a prop trader who, ironically, the only reason I knew about him is my son got a job as a trading assistant, and he was working for him, and he told me about him. And the amazing thing how he managed constantly, he was always winning, even when he was wrong in the market. And I had this interview with him, and the day I came in, I remember this. So it was one of these days where it was after a period where the market had gone up for several months, almost every day. This was back, I guess it was early 2011. And the day I came in, that day, the market finally had a big break. And I knew that, for my son, I knew that he had been short, and I came in that day, and he was completely it was like a day where you would expect him to be really ebullient and enthusiastic, and really, bubbling over, sort of making back a lot of money. And you couldn't tell anything had happened that day. And I'm sure if I had walked in and it was the reverse and he'd lost a lot of money, it would have been the same thing. Just kind of even keel. And that's the thing about really good traders and really good rock climbers, and I'm sure really good a lot of things. It's not an emotional thing. It is really a careful, controlled thing. And if there's a lot of emotion to it, then something is wrong. And that's why I love that quote.
Do you think you think that aspect can be learned?
Well, if it's not learned, then you're going to lose money. So the market will teach it to you. You have to find a way, I think you have to find a way to trade where you minimize the emotion. And there are lots of ways to do it. And, a simple way is, and I've given this advice, through the people I've interviewed and quoting them on it, and also it's on my own belief, is one pretty good idea is, and Bruce Kovner of Caxton was the first one I think I interviewed in one of my books who said this, was before you put on a trade, decide where you want to get out. Decide where the trade is wrong before you get in. You do it then, you have complete objectivity, and you take away the emotion and all the turmoil of trying to decide what to do for position once you're in if it's not going right. So by doing that, if you say put on a position, you say, okay, I'm buying X at 75, and if I'm right, it shouldn't go to 73, and I'll put a stop in at 73, and that's the end of it. And you don't have to worry about it anymore. If you're wrong, you'll be wrong, and you know what you lost, and it's something you decided that's in line with what you can afford to lose, and it's in line with what the trade shouldn't do, and you remove the emotion. If, however, you just buy at 75 and it starts going down, and then it's at 74, and then it's at 73.50. Now you're deciding, what should I do? And it gets to 73. Well, maybe it'll bounce back, and you have to make all these decisions. Well, a simple way to get the emotion out is make the decision where to get out before you get in.
And what's really interesting about that statement is that, especially in this book, that applies over so many diverse trading styles. This is not this book is, when everyone gets this, you're going to see there's so many diverse trading styles in here. But one of the commonalities is clearly, and I even quote the one gentleman here from the first chapter, Colin O'Shea, and he says he wants to have a price point to invalidate his hypothesis before entry. And he's not a trend trader per se. He's more of an econ guy. But I think you're making that point. And I see that commonality across this book, regardless of style.
Yeah, the styles are, in fact, extraordinarily different. In fact, they're almost more different than if you tried to make up different styles, you'd have trouble making up styles as different as the range of styles than the people I interviewed. So there's really no commonality, none, in what these people do to make money. But there is certain, as you point out, there is certain commonalities in terms of things like how they manage risk. Not all the same, but this idea of deciding what invalidates your trade is one that is shared by a number of traders. And Colin O'Shea states it as well as anybody. And he makes this one point that I particularly like, and he makes it in a way that I like the way he phrases it. He says that most people pick their stops by how much pain they can stand, and that's entirely wrong. What you need to do is pick your stops by where it invalidates your trade, not by how much pain you can stand. And if where it invalidates your trade is too painful, then that means you should be trading smaller. Not that you should pick a closer stop and have one that you can live with. If it's too much money to the meaningful point, then trade smaller. And if it's less than one contract, well, that's just not a contract. That's just not a trade you can do.
Yeah, I really enjoyed the chapter that Colin had, and he had some interesting discussions in there. And we've got a bunch of different places I want to target, but he had an interesting view how he was talking about the NASDAQ bubble period time, and it wasn't that he was necessarily trying to go short at 5,000, but rather 4,000. He was looking for that confirmation of things had changed, which I thought was really a nice direct way of saying it.
Yeah, well, the important point is, and he has some interesting, there are a lot of things in this book that are, I kind of think, different than people think. They're from traders who've been very successful, but what they're telling you is really not the way most people think it should be done. So mention bubbles to people, and what they think is, oh, wait, the way smart people make money in bubbles is to anticipate the bubble top and go short into the bubble and make money from all the fools. And interestingly, column on the subject of bubbles saying really the best way to make money in bubbles, well, there's two parts of it. The first part is you actually want to be long during a bubble because bubble moves tend to be relatively smooth. After the bubble bursts, it gets to be very, very jagged and very tough to stay with the trade on the downside. So actually the easiest place to make the money is along with the fools, so to speak. But of course, you're going to do it in a way that's tail protected. So that's the first thing that's sort of non-conventional about the way he looks at bubbles. And the other part of it is okay, you're expecting this thing, you look at this thing as a bubble. When it breaks, you're ready to now trade from the short side. And even though you're trading from a much worse price than you might have gotten in only a few weeks earlier, but it's the only way to do it, because if you try to do it while the market is in its vertical ascent, odds are that, or not the odds, but you have a very strong possibility of having to absorb an enormous amount of loss, probably more than you can stand, because when you get into that type of psychological phase, there's no telling how high the market goes. The NASDAQ happened to top a little above 5,000, but it could have been somewhere above 4,000, it could have been above 3,000, or it could have been above 7,000. When you get into those markets, there's no rationality. A stock goes from 1 to 100, a stock goes from $10 to $200 and then back to 10 or even down to 1. If it went to 200, it could have gone to 300. There's just no way of telling. So those are some of the points. And the other point that relates to this whole bubble idea is when you do get the bubble finally burst, and this is kind of a tangential related idea that he brings up that's important, the best way to take advantage is not necessarily the direct way. So the direct way would be, okay, short NASDAQ. Well, the problem with that is the NASDAQ move is going to be awfully choppy. In fact, during the summer of 2000, most people don't realize this or have forgotten this. You would think that if you went short the NASDAQ sort of in April or May 2000, you'd be sitting pretty and it would have been an easy move and you would have made lots of money. Well, the fact is that somewhere along the line, not that much further, somewhere in summer of 2000, there was a 40% plus rally in the NASDAQ. 40% plus. That's a hell of a retracement. And I don't know too many people who can stand that type of heat. So odds are, if you were short, you would have gotten knocked out. Now, what did O'Shea do? He actually didn't go short the NASDAQ. He said to himself, well, okay, this was a bubble. It's over. What does that mean? Well, it means the economy is probably going to weaken. What else does it mean? Well, it means that interest rates obviously have got to come down from where they are now. So what did he do? He went long bonds. And the beauty of that is that the bonds were a relatively smooth up move, totally correlated. The up and move in bonds were totally correlated with the down move in equities, but he found a much smoother way to do the trade. So that leads to one of the other lessons I cite in the book, is that how you implement a trade is actually more important than the trade idea itself.
I'm going to jump around some because I don't want anybody to accuse me of saying, well, Covel, you picked the first chapter. You only read one chapter. That's not the case at all. So, but I have to tell you, I got the e-file, so everyone knows, I've got the e-file out there, and I actually got the hard copy yesterday. And, look, I know everybody's in love with ebooks and all that kind of stuff. But let me tell you, I'm holding this thing in my hand right now. It is, I don't know, 1.5 inches thick, 1.25 inches thick. It's sharp looking. This is, I don't know. For me, I want this on my shelf. I mean, I want this thing that has some weight that I can hit somebody over the head with. And this is a dense book. And I'm going to jump around a little bit on chapters here, because I think there's all kinds of interesting characters in this book. And I'm not going to even mention them all by name today. But I want to jump ahead to speaking about Ed Thorpe. And I remember back in the day, it was probably inspired by something originally said in one of your books about blackjack. And I went out and I bought the Beat the Dealer book, and I read that thing. And I was attempting back in the day to try and connect all that thought process. And here you are, you have this great interview with him where he's talking about all of his gambling experiences and his trading experiences. And as you point out, you're like, most people would probably not see the connection. Maybe you can speak to some of your looks a very interesting conversation with Thorpe.
Yeah, well, a couple of things. Well, first, let me answer directly your point here about connection between gambling or we should maybe say not gambling, but games of chance and trading. And in Thorpe's case, he did both. So there's a natural connection. But the best way to illustrate it may be to give a specific example. So take a game like blackjack. Blackjack, if you just bet a fixed amount every hand, you're going to basically lose money over time because the house has an edge. The edge in blackjack is less than it is in most games, and if you're gonna play a game in a casino, you might, the best odds is blackjack, but it still is a losing edge. However, what Thorpe realized mathematically was that if you varied the bet size dependent on how attractive the individual hand looked, that you could take a game that had a negative edge and turn it into a positive edge. And that's a really powerful thought. I mean, here is something, it's like you have a coin that you're flipping, and the coin doesn't even land on, it's not even 50-50 heads. It lands on tails 52% of the time. Yet he realized that because it's not purely random, that by betting more when the odds are better, you could take that 52% odds and turn it 52%, 53% in your favor, just by varying the bet size. And the analogy to trading is that one thing, and again, you need to, a lot of this is having some level of sophistication in what you're doing. So most traders maybe will bet the same thing all the time. The really good traders, when they have a trade they really have strong confidence in, or they think has great return to risk potential, they will bet more. As George Soros said, as I quoted Druckenmiller in one of my books, quoting Soros, is you have to know when to step on the accelerator. So part of it is betting more. And in blackjack, it's when there are different ways of doing it, but when they're, say, when there are not many not many tens and picture cards out, you bet more, and vice versa. In a simplistic way, that's what that concept is. So you're taking a game which has negative edge and turning it positive edge by varying the bet size, and the same in trading. And in trading, it also means that when the odds are less, you either bet less, you take a smaller size, or you don't trade at all. I'll take a jump here over to another trader in the book who's actually more of an investor. He's the only person in the book that is more akin to a long-only investor because he just goes short every occasionally always less than 10%. So he's much more like a long only investor. And and this is Kevin Daly, and over a 12-year period where the S&P was like flat, he was up over 800%. And part of it, of course, is a stock picking, but a big part of it was just by being out of the market at the right times. And so when the odds were not good, he didn't trade. He traded very small. He had very small positions. So this idea of varying the position size is a really important idea that can improve anybody's trading. So that's one example of a connection. And I could talk a lot, but I kind of skipped Thorpe in his broader sense because I was trying to address your question. But if you want, I can go into something.
Well, here's the thing I want people to understand about this book. This is not a book. I mean, I read it over the weekend, but I could probably read it about 5 more times right now. This is not one of these books that you are going to just sit down and gingerly mosey your way through. You're going to have to sit down, read this, go back and look through it. It is dense and it covers a lot of material, cradle to grave, A to Z. And there's so many interesting little side notes and nuggets. And I thought one of the most interesting things about Ed Thorpe was that he found perhaps Bernard Madoff before anybody else.
Yeah, that was one of in fact, in Thorpe, there was like it was just like an astounding list of things that he was first at. I mean, in fact, of all the people I've interviewed, he is probably the single most amazing person in so many different ways. So you're right. So let's pick Madoff. Yeah, he actually found Madoff probably. I'm trying to think how many years before.
His description of that was great, though. The way that he kind of figured it out was just it's worth the price of admission just to read that.
And he did it very carefully. He did it through analyzing the trades. And I mean, he realized, and it's in the book, and I won't go into detail in this podcast, but he put together that there was no other conclusion other than this had to be a fraud. Yeah. And he discovered that before many years before Marco Polo actually did. Nobody knows about it because he didn't make a big push about it. The investor who asked him about it, he basically told that I would get out. This is a fraud.
It's one of those side stories that I could have you talking for a half hour, but it's one of those things worth reading. Like I said, I'm going to jump around, but I want to. There was
before you jump, just one other thing which I thought was amazing about what he was first at is that he found the Black-Scholes model formula.
It's true.
About 4 years before Black-Scholes, published their results. So he was really the first person to figure out the formula for pricing options. But in those 4 years, he was making tons of money trading it, and he just didn't want to publicize it to the world.
Well, you could probably say that maybe some of these traders that didn't get the publicity in the academic sense, perhaps maybe their achievements should have got them the Nobel Prize. Perhaps, maybe some of the academics got all the notoriety, but some of these great traders were actually implementing some of these great principles before the notoriety hit.
Yeah, that's something that I think very, very few people, I mean, I certainly wasn't aware of it. I doubt hardly anybody is aware of it, that he was really the first person to actually use the formula, and he did it many years before it was ever published. So that was another kind of amazing. And he also invented first person to do statistical arbitrage, first person to do convertible arbitrage. He was just an amazing person. Another thing, just from the academic side, this is another tidbit I kind of mentioned because I found it sort of so incredible. He was in a PhD for physics and got to his thesis writing stage and decided he didn't know enough math. So he went back and started taking graduate courses in math and then got a PhD in math. And he never went back to finish his thesis in physics, but besides that, he had done all the PhD work as well. But this is the kind of individual he was.
Everyone's listening here, like I said, this is a very dense book. There's a lot of information here. But one of the comments that caught my eye in the book, considering you've really interviewed a phenomenal number of top traders, and there's a gentleman in here named Steve Clark, stat arb trader, I believe. And I think you make the comment in here where you said he's the most honest trader that you've spoken with. Was it just for this book or in general overall?
I think in all my books. And that was an amazing interview. I'll give you the context of this. And this is not in the book, so here's something that's not in the book at all that we can talk about. There was a trader that worked for Steve Clark. It's a group, Omni in London, and there's several hedge funds, and there's the general hedge fund that he oversees, and a couple of other strategies, separate ones. And there was a global macro guy who was very good, and I went to interview him. Now, that interview ended up not being in the book. The guy has a very good record, and he's a very good trader, but the interview just didn't work well. And without going into much detail, but in all my books, I have to do more interviews than I actually use, because I have to feel that the interview, once transformed into a written chapter, is going to work as a written chapter. And in this case, I didn't feel I could transform it. But he was the catalyst for my going there to begin with. And then I knew there was this other fund that the main fund also looked good, but it was an arbitrage fund. And it's very difficult to make arbitrage funds sound interesting. So I was even reluctant to ask for an interview. But I figured, hey, I'm going there anyway. I might as well interview Clark, who runs the arbitrage fund, and who's the head of the whole group. So I had the first interview first, and then I did Clark's interview. And I had such low expectations. I thought it was going to be boring. It was going to be very difficult to turn it into a thing. And he goes into his life story, a kid from sort of the lower middle class in a suburb of London, and no college education, and how he got into trading and ended up, becoming in arbitrage and all these other things. But his life story was really interesting, and he was very, very honest about all aspects of it, and very emotional at times, and very honest about what he liked and what he didn't like, and how he felt unfulfilled in his life. And it was just sort of almost a brutal gut level of honesty in that interview. And that's why I say, of all the people I interviewed, I thought he was the most genuine and honest of all. And he came up with a lot of extremely colorful anecdotes. And so personally, I really liked the interview a lot. I even considered making the first chapter. It was one of the ones I was considering as a possible first chapter.
Yeah, that line caught my eye because, like I said, you've talked to so many different guys, and that seemed like such an affirmative statement. I was like, wow, that must have really struck you, this interview, this gentleman.
Yeah, you could see the emotion when we were talking, and it's sort of like you watch an interview show sometimes, and the person gets a bit choked up or whatever, and they'll focus in on the face, and you could see the emotion. Well, I don't know if it comes if I got it across in the book, but it was that type of emotion that came across in the interview.
So I told you, this is what happens when you write a book with all these interesting people and different anecdotes and stuff. And so this is how my mind is circling around your material. But so there's another trader that you spoke about in here, and listen to the audience out there. We are lightly touching because these are dense, like I said, lightly touching on aspects of these chapters. You have a gentleman named Jaffrey Woodruff. I'm pronouncing that right, I think. Yes.
Yep,
okay.
Yep.
And he's a CTA out of Charlottesville. And I thought the interesting thing about him, not a trend following trader, not a counter trend trader, but a pattern trader with a firm called QIM, self-taught programmer. I think the most interesting thing for me from that was definitely not a silver spoon guy, if I'm reading that correctly, but he was definitely influenced by Bill James, the sabermetrics guy. I mean, we're talking Moneyball here, seemed to be his philosophical foundation for a lot of what he does and how he ended up developing his trading firm. Am I beating up the right trade?
You got it exactly right. Yeah. If there is an idol that he would have in terms of expressing his philosophy, Bill James would certainly be it. And it's interesting how these things, which are unrelated to trading, actually have analogies directly to trading. You might not otherwise expect it. And in the case of Bill James and the whole topic of sabermetrics, it's the idea that by looking at different types of statistics and patterns, you could get a lot more information than you could by what was the typical popular RBIs or whatever. There were more interesting statistics that you could get, or that would give you patterns that were more meaningful. And it's very much along the lines of Moneyball, and well expressed by that. In case of Jaffrey, he essentially took that philosophy and tried to, and ended up finding patterns in the markets and building an approach that could find patterns. The big trick there was to do so without overly data mining and curve fitting. And some of the stuff, of course, gets to be proprietary, and there was some of the stuff he would only go to in detail just so far. But the essence of it is, and that's why I call the chapter The Third Way. As you said very correctly, he's neither a trend follower nor a counter-trend trader, but his process is really to find patterns in the market, and that is what he does.
Well, let me ask you, because I've got a couple more guys and some big picture principles I want to run over. But let me ask you, as the guy that goes down this path, and there was a certain amount of time between this book and your last Market Wizards books, what were some of the things that you would want to be asked about that you, I mean, obviously it's in the book. There's a tremendous amount of material in the book and your own views too. But what's your big takeaway? How did this change you? How did this book change you? How did all these interviews change you?
That's a good question. I can give you, well, let's see what I can think. I can think of one comes to the top of my head. I'm sure there's more than one way.
Putting you on the spot, Jack. Putting you on the spot.
No, that's fine. That's great. Keep me from falling asleep. That's good.
Come on. I wouldn't let you fall asleep.
No, I'm teasing. You're actually asking very good questions. So it's an interesting interview for me too. And that's good. I'm enjoying it. So that is an excellent question. So how did it affect me directly? I'll give you a good example. Jimmy Baladimas, the trader I talked about before, that my son apprenticed to. And, well, his style of trading, and we may as well go into it here, and he is probably talking about, first, of all the books I've ever written, he is the most different trader of anyone I've ever interviewed. And as I begin that chapter with a line that I think is very apropos, and it's also one of the better opening lines I have for any chapter I've ever written. It's a very short one, and it's simply Jimmy Baladimas breaks all the rules, and he does. And he sells into rallies. He doesn't use stops. He does things that are really reckless or seemingly reckless, but yet he makes money year in, year out. And I actually, not facetiously, even semi-facetiously, but also seriously, in the conclusion of that chapter, warn people that this chapter should be looked at like those late night infomercials where, don't try this stuff at home. So having said that, though, one of the things he does, and one of the ways he makes money, even when he's wrong, is he's constantly trading around positions. So he has, these months, when I went to interview him, the 3-4 months before I interviewed him, the market was up every month. He was short every month, and he made money every month. Or he broke even, but he didn't lose much. And the reason why that was true is because he's always trading around the position. So if he's short, the market goes down, he takes some. It goes down more, he takes some more. It goes back up, he resells it. So he's constantly making money trading around his positions. And I kind of believe in the idea of trading around positions anyway, but I think seeing the power of that, the way he's applied it, and understanding that even when you're wrong, if you do that part of it well, you could still end up ahead, was, I think, an important influence. And I think it influenced me to do more of that in my own trading, to be more inclined to take some off when it's going my way and put it back on. And one interesting thing about doing that is, if you think about it, it's going to help you. When is it going to help you? Well, it'll help you when the market goes into a correction. Well, you'll pick up some money that you wouldn't have. It may also help keep you in the trade, because if you're picking up money on the correction, you actually are happy when it's going against you, because then you can put the position back on. So instead of getting out of the whole thing, you're actually putting it back on. So it's very beneficial in those type of cases. Where is it going to hurt you? Well, it's going to hurt you if you take some off and it keeps on going. Well, what does that mean? That means that you've made money on the rest of it, so you make less of a windfall profit. And I like that trade-off. I like the idea that you're doing something in trading where it's going to help you when you would have been losing, and you're just going to give up some money when you would have been making more. I kind of like that trade-off. So I found that kind of an influence. It wasn't something that I had never done or anything like that. It wasn't a sudden insight. The insight was more understanding the power of it and getting a better appreciation for that as an approach. It is also, if you think about it, a way where you could be sort of not wrong necessarily on a trade, but let's say you go long or short and market ends up chopping around, doesn't go anywhere. If you're doing this, you could actually end up making money on a trade where the market doesn't go anywhere from beginning to end, because you're selling some when it's going your way and then putting it back on when it comes back. So that's a good example of how there was an influence, but it's not certainly the only way. A lot of these traders had definitely have had an influence in things they said ringing true, and maybe reinforcing just things, even if I already knew them.
Jack, overall, the gentleman in this book, is it a fair assessment to say, I mean, self-starter entrepreneur types, really not silver spoon guys? I mean, a lot of these are self-made men.
I think so. If you think about all these people, and I'd have to go one by one, but almost all of them that I think of really came from, they didn't come from wealth. A few of them did come from upper class backgrounds, to be sure, but most of them really didn't, and some of them came from really, almost poor backgrounds. Thorpe grew up in the Depression, as an example. Clark, a poor working class family, that type of thing. So those are probably more representative of the backgrounds of these people. Very few really had any money when they started.
Well, let me. I know I mentioned early on that there are some very large names in here, and so just to whet the appetite of folks that are listening to this. So your second chapter is about a guy who, as far as I can tell, is the man when it comes to making gross money. I think you say he's made $50 billion for investors over 20 years, and we're talking about Ray Dalio at Bridgewater. So let me ask you, without going into and sitting here like I've done before on some of these other traders, what can you tell us about Dalio, your lessons, your insights, what you took away, some feeling that perhaps isn't really in the book, something that we're talking about the gentleman who has really just made an amount of wealth. It's hard to count. So what can you tell us that's not out there floating in the ether already about this gentleman?
Well, there's just a couple of things. For one thing, let me just say, in terms of his accomplishments, you have records out there like Joe DiMaggio's that maybe never get broken. And if I had to say, of all the traders I interviewed, what record will never get broken? Thorpe may be on his number of winning months, percentage of winning months, but Dalio has done one thing that I think is almost inconceivable that anybody could do again. And that is having a huge percentage year, and I forget what it was, like 30% or whatever. It was some very large money, managing $50 billion. You would have asked me, a few years ago, before he ever did that, I would have thought it would be hard pressed to even make money managing that much money. It seems like such a huge disadvantage. but to be able to make a huge return managing a giant sum like 50 billion, that is like one of the most incredible feats that have ever been achieved.
And nearly systematic to add, right?
He's systematic here, but systematic different from
Absolutely.
what other people think of systematic.
Absolutely. Save that for the read. They'll have to read about that.
Well, yeah. Well, we can tell them, we can say here that systematic without technicals, really.
Yeah.
So
it's very interesting.
Dalio is very opinionated. He knows what he thinks is right and where he wants to go. And I think like a lot of great people have that quality, like Steve Jobs in a different field. Sort of the visionary people have that self-assurance and understanding. One of the important things there's a number of things that we won't go into all of them, but one thing I think that's important that Dalio brings out is that markets behave differently in different environments. So if you look at markets, and I'm speaking now fundamentally, not technically, but if you look at certain fundamental factors and try to find consistent ways in which they behave, according to Dalio, you're dead before you start, because that's not the way markets behave. Markets will behave very differently, say, if you're in a recession than if you're in a liquidating depression type of economy. Same fundamentals will work very differently, and you have to understand that. Otherwise, you're just going to be completely wrong, because you're trying to force one model across different markets, and the markets are just more complicated than that.
We've only got so much more time left here. I know I can't keep you all day, but hopefully we'll make the best podcast. So when people want to hear about this book, this is where they're going to go. So let me get you to be teacher for a second on a principle that is featured around one particular trader, and I'll let you name him, but I think it applies to a lot of these traders, and it's a kind of a very academic sounding statement, and perhaps you can break it down, but asymmetric positive skew trades. That's going to take some people a little bit of time to sit down and kind of wrap their arms around, but it's an extremely important point.
Yeah, it is, and I love that philosophy of trading, and it probably, I'm sure, comes through in the book. So what does that mean? Well, to put it in plain English, it means that you put on trades that have the potential to make a lot of money, but even if you're totally wrong, they can't lose very much. Now, the simplest example of this is a long option trade. Now, a lot of people will say, well, buying options is a mug's game. Options are overpriced, and you'll bleed money, and they'll do studies where if you always buying options, you'll end up losing. And all of that is true. And I'm using options only an example of how to set up a trade where you can make a lot more than you can lose. And I'm trying to also, in doing that, I also need to explain what's wrong with the way most people think about buying options. What most people really miss is that while on average, options have a somewhat of a negative edge, just like if you buy insurance on your home, the odds are, your house is not going to burn down, and the percentage, even across the whole population, home insurance buyers will lose money relative to the amount of money they collect in premium. And if that weren't true, insurance companies will go out of business. So that part of it is true. It has a negative edge. Okay, it's inevitable. Long options have to have a negative edge because you have to entice people to take the risk to sell you the option. Having said that, what the people miss is you don't have to be in the game all the time. The beauty of options is you can pick your spots. And if you can pick a spot where the market has a much better chance for having a large up move or a large down move at that spot, then options provide you They provide you actually a positive edge, but more importantly, they give you a way to trade that type of situation and have a very large potential on the upside while only risking a little bit on the downside, namely the price, the amount you pay on the option. So when some of the traders I've interviewed make a big deal about structuring their trades in ways where the upside is open-ended and the downside is very limited. Jamie May is one who's always does it, I think, on every single trade. Kyle Moshe does it for most of his trades. And the simplest way I said is, as I said, is long options, but there's also being long CDS. There's other ways of doing those types of trades. But the simplest way and the way applicable to most people, or the way most people can do it, is by being a buyer of options, but at the right point in time. The great thing about it is that it's a way of controlling risk, but still giving you significant upside potential. And it's one of the ways where these great traders, it's one of the ways in which they are able to get very good return to risk performance.
Yeah, I think it's terribly important. I think the first gentleman you interviewed him in one of your original books was Larry Hite, was always big on this concept. He had brought this up multiple times with me. So I saw that. I was like, oh, that's right on target. Let me, like I said, as we kind of wrap up, I can't keep you all day. I know people like to listen to you all day. I know I can always learn. But in the rear of this book, it's really cool. And I can't go into all of them. There's 40 of them, and you call them your 40 market wizard lessons. And I think, it's obviously you're taking all these great insights and kind of reducing them to something that helps to kind of summarize what's going on in this new book. I want to give you the ability, though, here to expand on something, because I find this sometimes in my work. I'll get readers and they'll see something and they'll think they found some discrepancy in that I've written about. And I know I'm looking at number one, and number one is you're saying there's no holy grail in trading. I think hope most people can believe that's true. But number 26 is interesting, and I wanted to talk about this, the power of diversification. And you mentioned that Dalio says that is his holy grail to investing. So I don't know if you might want to kind of speak to, there's layers of how you're using that term.
Yeah, diversity. There are a lot of things that people kind of gloss over because, diversification, I know it's important. But what I think people don't understand sometimes is how powerful some of these things can be. And one thing about diversification, and I use it in one of my other books, is it's the line, I think something along the line of, it's the only free lunch on Wall Street. The thing about diversification, if you do it properly, it's a way of dramatically improving return to risk without really any negative to it, without any downside. And what Dalio's point is, if you have a strategy, and you pick your best strategy, and it has a certain return to risks, and that's good. But if you can find unrelated strategies, truly uncorrelated strategies, that you can increase your return to risk by as much as a factor, if they're really uncorrelated, by as much as a factor 5 to 1. So he sees there's a tremendous amount of potential improvement you can get in your return to risk, and it's all return to risk, not return, by diversifying. The way he does it is he finds ideas that have different drivers. So he's not paying attention so much to correlation, because correlations are misleading. They're backward looking, and you can have things that were uncorrelated can become correlated, or vice versa. What he prefers to do is to look at things that have different drivers. And if they have different things making the price move, then one should not be related to the other. And he puts together at least a minimum of 15. They have many, many more positions, but at the core, say 15 plus core positions that are completely unrelated. And that is one way he's able to get significant return while still keeping his risk in control. And diversification is something that applies not only to as a trader, but it's also when you're investing. And sometimes that people talk about putting together a portfolio, say, of managers, and people will say, well, yeah, you put too many managers on, then you're diversifying your way you return. And I think that's kind of a very narrow-minded way of looking at it. because if you only pick managers that you feel are approximately equivalent in their potential. I mean, you can always pick the managers that are the best in the past, but going forward, you really don't know. So even if someone did better in the past, you don't necessarily think he's going to do better in the future. So, or you shouldn't, because there's a very poor correlation there. So if you're picking managers you think have equal probabilities of getting about the same return to risk, then you should have more. You should diversify, because if they all have similar expectations, you're not reducing your expected return, but you are reducing your expected risk. So again, it has a lot of applications.
You know, one of the things I did not set up here in the beginning is your process for how you selected managers. And you went about saying, okay, I want to target guys superior return risk performance. And I'm going to let you expand on that and how you went about that process. As you think about it, though, one of the questions I would have for you would be your definition of risk as you lay that out.
Right. Oh boy, that's a good sub. Let's take that, and we'll come back to the process. The subject of risk, because this is one, and I mentioned that I have another book that I just finished writing, and in there I kind of have a whole chapter on this. But it's the whole confusion about what risk really is. Now, somewhere along the line, most of the investment community and a good part of the academic community, maybe most of the academic community for that part, has decided that risk is volatility. And the interesting thing, now sometimes it is, but the interesting thing about that is that you can have things that have very low volatility that are extremely risky. And in fact, their low volatility is one of the telltale signs of potential risk. It's not a sign of low risk. It could actually be a sign of potential large risk. And you can have things that look very or are very volatile and yet have very low risk. And I guess we can kind of give an example of each. So, and this is where people go wrong all the time. They look at track records and they look I want a guy who doesn't lose much ever and has, makes a little bit of money, and that's great. And that's great as far as it goes, but you have to understand where are the profits coming from. So a lot of hedge fund strategies make their money by putting on the types of trades that win most of the time, but every now and then the train goes off the tracks and you'll get clobbered. But if within their track record, that particular strategy has not had one of those episodes, it looks great. Now, the simplest example I can give you is a strategy like selling out of the money options, okay? So if I were, in fact, if you wanted to be a charlatan in this business and kind of attract a lot of money, probably one of the best ways to do it would be you start a fund where all you do is sell out of the money options, way out of the money options. Now, what's going to happen is in just about every month you'll be making money because the markets rarely go to those out of the money strikes. So the markets go up or down a little bit, or even moderately, is making money. The only time you get hurt is if the market really has a sudden, huge move. But the thing is, when it has a large move, you're not only losing money in that type of position, but you're losing money asymptotically, because those options you sold that moved 10 cents for every dollar the stock moved or the market moved now start moving 20 and then 30 and 40 and ultimately $1. So your position size is increasing at the same time you're losing money in that type of position. And what happens with these types of strategies is they get these strings of returns, which are very smooth, so low volatility. So the academics will look at it and say, oh, low risk. A lot of investors look at it and say low risk. But in reality, the process is one that has landmines planted sparsely. And it's fine as long as you don't step on one of those landmines. But ultimately, if you go far enough, you will eventually step on a landmine. And that's what happens. So that's an example of, and in 2008, of course, landmines were going off all over the place. And it was largely the worst hit the worst hit strategies were the ones which had these low volatility but high risk, what I would call low volatility / high risk strategies. So that's an example of low risk, of low volatility, not only not being low risk, but low volatility actually being associated with high risk. The reverse side of it is a trader like Jamie May, who structures all of his trades, as we talked about before, to be rightward skewed. And what he's always looking for is ways to put on trades where if he's right, he'll make a lot of money on the upside, and if he's wrong, he'll lose a little bit of premium. And there's a number of examples in the book about the types of trades he does. So we're not even go into that type of detail here, but it's basically the idea is that's how he structures the trades. And what does that do? That means that when he's right sometimes, he makes these huge profits. And when he's wrong, he won't lose that much. So you get a track record that has a lot of volatility. But the thing is, if you look at the track record, all the volatility, not some of it, all of it is coming from upside. And so you have a situation where you have high volatility, but his process is still relatively low risk because he can never lose very much on any individual trade the way he structures a trade. So it's a very, very important point, this breaking apart these concepts of volatility and risk. They're very different, and people go wrong all the time by linking them together.
Do you want to, I know we got a few more minutes here left, but do you want to touch on how you look at risk specifically, what your, in terms of your measures?
Sure. I have one favorite measure, which I put in a book. I call it the gain to pain ratio. And it's actually, I kind of always assumed that it was kind of out there and people, but then I started searching for it. I Googled it and I found it was used generically, but I found that actually, even though it's a simple measure and in my mind, just about as good a measure of performance as you can get. If I only had one measure, this is what I would use. But oddly enough, it wasn't actually out there as a standard type of measure. The only place I found it in was in measurements of trading performance, where it's measuring trades, and there's something called the profit factor, and that is a statistic that's out there. And for your listeners who are familiar with profit factor, which is basically looking at the sum of all all your profitable gains to the sum of all your losing trades, that is the same analogous type of concept, but it's applied to a trade by trade basis. However, taking it and applying it to time data like monthly returns or daily returns, actually it wasn't out there, and it's well, I call it a gain to pain ratio. So what is the gain to pain ratio? It's simply this: you take, let's say if we're using monthly data, you take all the returns and just sum them. And then you take all the losing returns, only the losing returns, and you sum those and take the absolute value of it, the positive sign. And you take the ratio of all your trades to all your losing trades. And that's what I call a gain to pain ratio. And it's actually the one measure I use most heavily, and I can almost do without everything else. And I just give me the gain to pain ratio and monthly data and daily data, and I really can't extract very much more out of the pure data. So the reason why that's so good, and it's why it's better than, I think it's much better than the standard measures. It's much better than Sharpe ratio, let's say, because it will only penalize losses. It doesn't penalize people like Jamie May who have large gains.
It doesn't penalize upside volatility.
That's right. It doesn't penalize upside volatility. It's much better than ratios like the CalMAR or ratio or ratios which basically take your returns to your worst drawdown, which is something I'm not a statistician, but I have a little background in statistics. It's just something that's distasteful from a statistical standpoint, because it's you taking one event, the drawdown, and giving it all the weight, which is just not a good thing to do. The thing about the gain to pain ratio is it counts all the losses. So your maximum drawdown is going to be in there, but so are all the other drawdowns, and so are all the individual losing months. So it's basically weighting every loss you have ever taken. It's essentially taking all your gains and normalizing them by all the losses you suffered to get those gains. And I find that statistic is just extremely meaningful, and it's even more meaningful if you take it down to the daily level. So, and I do have it in the book as an appendix because it is not a standard measure out there.
Listen, Jack, we've taken up your time. It's been great. I think people are going to really enjoy this. Maybe I've already asked this in a roundabout way, but is there any one that just stands out in your head, memorable sentence, feeling, meeting, interaction in this entire process for this particular book that stands out for you? Is there one thing that you just walk away with and say, wow, obviously there's more than one thing. Clearly we've talked about that, but is there that one that just kind of jumps out at you?
Yeah, we've talked about, I don't know if there's one, it's hard. It's always, that type of question is a little bit like the question I often
Which child do you like?
No, well, yeah, that too. But let's keep it to the realm of market wizards. One question I get a lot of times is, who is your favorite trader, or who's the best trader? Yeah. And I really have a rough time with that type of question because there's so many different episodes, that and so many different people. It's kind of hard, to think of which one do you take.
I find the commonalities are what I remember. It starts to become that common type of can do, make it happen person. I'm not going to quit. I'm going to survive. I'm going to make it. I'm going to get to the top. I find that's how I end up remembering the people in this world often.
Yeah, and that is a characteristic of a lot of these traders. As is typical in most of my books, you will find a fair smattering of the traders I interviewed who didn't start off successfully, but yet they had that drive. Yeah.
Well, listen, you where were you calling today? Where are you at today?
I am in New York City, overlooking Central Park.
Ah, delightful. Well, I'm in San Diego today, looking downtown San Diego. So, well, listen, Jack, I will get this up hopefully this evening, and I'm sure everyone will enjoy it. I appreciate your time today.
And Mike, so you did a really good job. I really enjoyed this. You asked a lot of intelligent questions, which is the great thing about being interviewed by a trader instead of sometimes someone who knows nothing about trading. But
well, I appreciate that. Let me ask you though, what's the best place for people to reach you? Obviously, you can go on Amazon, they can buy all the books, but is there a website where people can follow you along, or where can they find more?
Well, I do have a website right now, jackschwager.com, but pretty much right now it's more a venue for the books, and a couple of things are posted there. I haven't yet gone to the point of taking it over and really making it something, although at some point I will. For example, now we did this interview. I'm sure I'll put a link up to this and links to other things of that type. So one place is jackschwager.com. Okay. Perhaps not so much what's there now, but what may be there over time in this process. And I did start Twitter for the first time. The book was kind of the catalyst. I just started that a few weeks ago, and I guess that's a start.
Yeah, it's and then you'll be stuck for the rest of your life having to make tweets and Facebook posts, and it never stops. Well, the train never stops. So
I guess I'll find out.
Well, listen, Jack, once again, appreciate your time. I'm sure everyone will enjoy this, and have a good day up there in New York City today.
Hey, thanks a lot. Appreciate it.
Take care.
Take care.
Bye-bye. My guest today, Alison Gopnik. She's an American professor of psychology and affiliate professor of philosophy at the University of California, Berkeley. She's known for her work in the areas of cognitive and language development, specializing in the effect of language on thought, the development of a theory of mind, and casual learning. Definitely check her TED Talk out. Really interesting stuff. She starts her analysis, gets down to child development and looking at how we learn and we grow from the earliest months in our lives. And for those of you that might be thinking this is not your thing, trust me, Allison might have the most energy of any guest I've ever had on this show. And for someone that can make up the term Bayesian babies, which would be Thomas Bayes, Bayesian statistics, brilliant, absolutely brilliant. Let's jump right in with my conversation with Allison Gopnik. Professor, I have to say, when I dig into your world, my first thought that I have, I want to be in your class. I'm 49 years of age. I want to be in your class. I was thinking, why do I want to be in her class? And you can just feel this insatiable curiosity. I want to know for you. This goes right to the heart of your work. Try and place for me how that insatiable curiosity began for you. Look, we're going to talk about child development today. You must have had great parents.
Yeah, well, I had a very interesting childhood and very rich and wonderful childhood. But a big feature of it was that I'm actually the oldest of 6 children. I was involved and engaged with children for as long as I can remember. And I had this wonderful bohemian 1950s, early 60s childhood where my parents were actually graduate students and then young faculty, but they were basically crazy bohemians. And we had an amazingly wonderful, rich, again, slightly crazy life. I was a child actor, for example, for 5 years when I was a kid. And we went to see the opening of the Guggenheim when I was 4 and my brother was 3. We drove from Philadelphia to New York to see the opening of the Guggenheim. That was just the sort of thing that my parents thought made a lot of sense to do. So I personally had a wonderful, vivid childhood. But I think also being the oldest sister of 6 meant that I was very conscious of what the younger children were like and how interesting they were. And in some sense, how much people outside didn't appreciate how interesting and smart and just fascinating they were.
Do you have a moment in time being the oldest of 6 as a keen, obviously a keen observer, and that I'm sure you would say that translates in many ways to your current adult life, but as a keen observer from very young people at a very young age, is there a moment, was there something in observing your siblings that you can think back to that's like, wow, that's just fascinating to me. I'm in awe of that, or something that struck you early on?
Well, actually, it's funny because the moment that I can remember most vividly was that I was actually reading philosophy. So I'm an affiliate professor in philosophy, and my first degree was actually in philosophy. And when I was about 10 or 11, I read Plato's Apology with I read Plato's Phaedo, which is one of the dialogues where he talks about the fact that people would have to exist in another world, another Platonic universe before and after this life, because after all, it doesn't make any sense to think that we just have this limited existence in the world and nothing comes before and nothing comes after. And what struck me in that conversation was that it just seemed obvious to me that a way that you continued on in the world was through your children, that you had children, that you raised children, that each generation of children was going on in the world. And it was amazing to me that for these incredibly smart philosophers who I tremendously admired, like Socrates, the possibility of even thinking about children didn't even show up in that dialogue. And I can remember being very struck by the fact, like, what was wrong with these guys? Why weren't they going to the obvious answer, which was thinking about the way that children make you immortal and extend you into the future and the past? And that reaction was a reaction that has really shaped the whole rest of my career. It's been, look, here's this deep, important, interesting question. It's just obvious that children are going to be able to tell you something about it. And yet the attitude towards children for all those years, even when people were sort of abstractly interested, was that they were part of the world of women and domestic life and were part of the sort of serious intellectual philosophical universe.
I love one of the ways that you phrase this, and I had so many aha moments going through your world. Babies are like the research and development operation or arm of the human species. I mean, this is where it starts.
Yeah, exactly. And I think if you actually spend time sitting and watching babies, another vivid moment that I remember was when I was in my first year of graduate school, which is a wonderful time for anyone. Andrew Maltzoff, who became a famous developmental psychologist and was a young fellow graduate student, I guess I was just turned 20. We were sitting in a field looking at a bunch of babies who were just crawling around on picnic blankets in a field the way that babies do. And we just counted up how many experiments does a baby do in the course of the 5 minutes that we were watching them. And I highly recommend this. It's a really fascinating exercise. Just take, anybody under the age of 3 and just watch them for 10 minutes and count how many things they find out about, how many things they think about, how many things they try, just in that tiny brief period of time, and then compare that to how many new ideas or new discoveries you have in the course of maybe 5 years. And the babies, it's pretty clear that the babies are finding out more about the world in 5 minutes than most of us do in 5 years. And I think that's actually a really important biological fact about who we are as humans.
I like to tell people all the time that I'm a big baby, and not like in some weak way, but really because I try every day. And I think I'm very lucky with this podcast to talk to people like yourself. It keeps me fresh. It keeps things open. It doesn't close doors. Every time I get on this show, I'm like, wow, that was amazing. I can't believe they dedicated their life to that. And then I get to pick their mind and see something really interesting that I never even considered.
Well, one of the ideas that I've been working on most recently, is the idea that there's this kind of basic tension. You see it in neuroscience, you see it in computer science, you see it in technology. There's this basic tension between what people call exploration and exploitation. You're trying to solve a problem. One thing to do is to look around and try and explore as many different possible solutions as you possibly can. Another thing is to narrow in on 1 or 2 solutions and really implement them, really make them happen. And I think it's important that you need to do both. So we would not want to have a world where everyone was like a 4-year-old, for one thing, because a bunch of other people would have to be taking care of that 4-year-old. There's something to be said for these adult skills of focus and narrow attention and executive function and planning and all the things that we're very good at doing in adults, the things that the production and marketing divisions, as it were, are doing. But all of that wouldn't have nearly as much potency if we didn't also have both individual people or times in our lives or developmental periods when instead we could just be exploring. We could just be finding out new things for the hell of it. We could just be curious. Here at Berkeley, there's just a lovely new study that some of my colleagues in AI have done where they took one of these very powerful machine learning algorithms and they just gave it curiosity. They added a bit that said, okay, when you're trying to solve these problems, just go out and try and get more information for the sake of more information. And it looks as if that would be counterproductive, right? You're supposed to be solving a problem. You're not supposed to be just going around and trying to find out more about the world. But it turns out that that kind of system is actually more effective than a system that's just narrowly focused on accomplishing particular goals. And I think that's the function that preschoolers play for us. And if you sit down next to a preschooler and just watch them for a while, one of the great pleasures of developmental psychology is you can actually see that happen. You can see it unfold before your eyes.
I've got a ton of questions here. I want to dive at the child level, but I think it'd be very useful for the audience for you to give the big picture, and the term I want to use from your world and many of your peers' world, life history. And why don't you explain life history from your perspective and perhaps contrast that life history to other animals, like other primates? We're kind of very different, us humans, aren't we?
Yeah, that's right. And it's interesting. If you go and you talk to evolutionary biologists, one of the ideas that they come back to again and again is the idea of life history. Life history is the way that an organism develops over its entire lifespan. So not just what's the organism like at its peak, as it were, but how long a period of childhood does it have? How long does it live? When does it reproduce? When does it become senescent? When does it die? That profile, that trajectory, turns out to be a really, really important factor in lots of arguments in evolutionary biology. And if you can imagine biologists from Alpha Centauri coming to Earth 150,000 years ago and looking at these new creatures that had just evolved, these little funny primates scurrying around on the belt and trying to figure out what's special about these creatures, what makes them distinctive, the thing that would leap out at her is, my goodness, these creatures have a really bizarre life history, because what she would have noticed is that human beings have twice as long a childhood, twice as long a period of immaturity as any of our closest relatives. So chimpanzees are producing as much food as they're consuming by the time they're 7. Even in hunter-gatherer cultures, we aren't doing that till we're 15. And, my son is 30 and we're still writing tuition checks and writing tuition and rent checks when they're 30. Now, that seems paradoxical. Why would you set up a species so that there's this long period when they're not producing anything, and worse than that, they're actually requiring all these resources from us just to keep them alive? So it's a very distinctive, striking thing about us. And if you compare us to, say, chimpanzees, to our closest primate relatives, we seem to have a lot of other adaptations designed just to deal with that long period of immaturity. So we have pair bonding. We have males and females who are close and who take care of children together. Only 5% of all mammals have pair bonding. We have what anthropologists call alloparenting, which means that we have non-biological kin who are helping to take care of babies. And we have my own personal favorite, namely grandmothers. So another really strange thing about our life history, again, very distinctive, is that we have females who are living past menopause. And we in general live to our 70s as opposed to chimps who live to their 50s. So not only do we have this long extra period early in life, we have this long extra period later in life. So all that seems very puzzling. And it's striking because when you look at lots and lots and lots of other animals, not just primates, not even just mammals, but say birds and even insects, you see this relationship between how long a childhood a species has and how smart and flexible and good at learning they are as adults. So there seems to be some connection between this life history, this long childhood, and then these very distinctive capacities that we have as adults for flexibility and learning.
That starts to get right at the heart of the matter where I was so fascinated with your work. And you're getting at, okay, if we have this long period where young people are developing and they really can't take care of themselves, and perhaps the rest of adult society is constantly thinking, well, they're not, they're just there, they're not doing much. On contraire, they are doing quite a lot. And I would love for you to explain the expression. I find it fascinating. It dovetails right into my world, at least the Bayesian part, but Bayesian babies. These babies are doing quite a bit. And it is, you just read this for the first time, you're like, wow.
Well, it's interesting because, of course, one of the things that psychologists have said for a while, my colleague Danny Kahneman got the Nobel Prize for saying this, is people are really bad at doing probability and statistics. And it's true that adults are very bad at doing probability and statistics if you actually give them a statistical problem. But it turns out that even 8-month-olds are actually extremely good at doing probability and statistics, and they can do pretty sophisticated kinds of Bayesian inference, but they do it unconsciously. They do it without knowing that that's what they're doing. And what we've been doing in my lab over the last 15 years or so is just giving children problems to solve that from the child's perspective are just a problem like, look, here's this machine and I'm putting blocks on it and tell me how the machine works. Sometimes the machine lights up, sometimes it doesn't. What's happening? How can you make the machine work? That's a very simple, practical thing that babies and children are very excited about doing. But it turns out that with that very simple kind of setup, you can show that the children are actually doing really sophisticated kinds of analyses of the data and ways of combining the data. Some interesting experiments that we've recently done. The preschoolers are actually, in some ways, better at doing that than adults, in the sense that the preschoolers actually take the data more into consideration. The adults seem to be designed to rely more heavily on what they already know. It really takes a lot of new data to change an adult's mind. Whereas for the children who know less to begin with, they know less to begin with, and they also seem to be designed to really pay attention to the data that's around them. That's the thing that's most important for them. The children seem to be able to do things like use conditional probabilities to infer causal structure from the time they're 2 or 3 years old, which is, I agree, is really, really amazing. And only one of the amazing things that have come out of work in developmental psychology over the last 30 years or so.
When you say that, the ability, the conditional probability ability as a very, very young child. Now, some people might be thinking, and I made the compliment to you at the top, I said, you must have had a great parenting system, great family life. And you said you gave a great story. Some people might be thinking, well, gosh, that's only if it's not for all kids. Speak to the issue, though, of that, the economic issue, children that come from the wrong side of the tracks. They don't have all the advantages. Speak to that. It becomes it's the nature nurture issue.
One of the things that we know, and again, this kind of goes with the whole life history perspective, is that you can only have that period of exploration if you also have a protected, nurturing environment. And there's at least some evidence with non-human animals that Animals who are stressed early in life, for example, seem to mature more quickly. So we're sort of forced into that adult state more quickly than animals who are nurtured. But I think it's important to say that nurturance, it means having people around you who love you and care for you. It doesn't mean having people who are putting you in, mini Harvard preschool, or it doesn't mean people who are going out and giving you flashcards. In fact, there's some interesting recent studies that suggest that when children are in a pedagogical situation where they feel as if they're being taught, that actually narrows the range of options they can consider. It actually makes them explore less. And we actually recently published a study just this year, 2017. We were curious about this. So we actually went to look at children in Head Start programs in Oakland. And we also looked at children who were growing up in low-income parts of Lima, Peru, sort of in the favelas in the suburbs of Lima. And we thought, well, maybe these children are going to have more trouble with the causal inference tests than the children in the middle-class preschools. What we discovered was, if anything, it was just the opposite. Especially these children in Peru were doing incredibly well on these causal tests. And the children in Head Start, even though they do worse if you do a formal IQ test, for example, they do worse on executive function tests. We were sort of surprised by how good they were, as good or better than the middle-class kids at solving these kind of spontaneous learning tests. Now, remember, from the kids' perspective, this isn't learning, it's not school, it's just here's a cool toy to play with and you're trying to figure out how it works. But I think it's important to say that the kids that we were looking at, both in Peru and in Head Start, are kids who are low income, but who have parents who care enough about them to make sure that they get into Head Start programs or into these schools in Peru. So I think it's important to say that the kids need this kind of nurturant, supportive, extended family environment, which is what they have in Peru. I think that kids are not going to do well on these things in situations of stress, violence, isolation, the situations in which very many children in America, by the way, are growing up. But it isn't as if what children need is to have the middle-class parent who's hovering over them and making sure that they, do their worksheets.
I have a side question for you about your personality, your perspective, your purpose as I listen to you. Why are you so passionate?
One thing about the kind of work that I do is that I'm with kids a lot of the time. Not actually quite as much time as I'd like, but a lot of the time. And, there are some kinds of projects, some kinds of professions where you do something because you think it's important abstractly, but you don't have an immediate sense of it being important every day. And one of the nice things about working with kids is you get to see the kids, and it hits you over the head every time you see a 3-year-old, just how smart and interesting and open to the world they actually are. And I think, one of the questions that people often ask is, well, as an adult, how can you keep this very open sense of exploration and possibility that children have? And I think actually having children, hanging out with children is a really important part of that. And I think even though we kind of give lip service to, yes, the children are our future and children are important, it's still true that, I've given talks at, for example, and it is true that if you're in a room full of people and you say that you study children, you can kind of see the glazing. Yeah. At least you used to see the eyes glazing over. That's not quite so true anymore, because I think people are starting to realize just how important this early period is. But it's a bit ironic that the way they realized it was because economists started telling them that there were going to be really good returns on investment. Whereas I think for me, it was sitting in the room with 3-year-olds. It was pretty obvious. When
you open up Pandora's box and you start talking about Bayesian babies and conditional probabilities, that room full of suits that doesn't think they want to listen might all of a sudden go, what did she just say? Hold on, I better pay attention.
Well, one of the really exciting things that's happening just at this moment is that if you look at the AI community, one of the things that people have really realized, part of the new excitement about artificial intelligence, comes because people are starting to make systems that can learn. That's been the real advances have all been in machine learning. But the people who are doing that work, I think, are starting to realize they're really bumping up against the limits of the kinds of learning that machines have done so far. And they're realizing that every 3- and 4-year-old can solve problems, can learn things that you can't get a standard, even, a wonderful deep learning algorithm with enormous amounts of data. They can't do things that every 3- and 4-year-old can do. So they're getting to be very excited about talking to cognitive development people and learning about cognitive development. I'm teaching a course this year at Berkeley called Cognitive Development for Computer Scientists. the students and indeed a lot of the faculty are computer scientists who want to know how is it that, babies and young children are the best learners that we know of in the world. If learning is going to turn out to be the key thing in AI, we should really be looking at these kids. So there's this kind of nice thing about having all these nerdy EECS guys suddenly saying, gee, babies and children, they're really cool and really interesting.
You hinted about it earlier, talking about the playground and observing babies. But let's talk about play for a moment. If you were to open up with that room and start talking about play, a lot of the suits might say, oh my gosh, I have to leave. But on the flip side, if people pay attention and start to say, hold on, let's really think about play. Let's try and put ourselves back at that point in time. One great thing about play is, Mike, you feel good. Why don't you talk about some of the bigger picture benefits there that we can learn from childhood play?
Well, play is another one of those sort of evolutionarily paradoxical phenomena, because not just humans, but all young animals play. And it's characteristic of young animals rather than older animals. And of course, the very definition of play is that play is doing a bunch of things that aren't actually going to have immediate benefits. So it seems like a kind of paradox. Why is it that for so many species, we spend so much time doing things just for fun? And the thought is that the sort of for fun is a way of getting a reward for this kind of wide-ranging exploration. The kind of paradox, which I think people are familiar with, is, sometimes if you're trying too hard to do something, that actually keeps you from doing it. And pulling back and just exploring and having fun actually makes you more effective in the long run. So it's this kind of paradox, which is to actually get things done in the long run. Often in the short run, you have to release yourself from the pressure of trying to get things done. And play seems to serve that function in the animal kingdom, and what the kinds of play that we do reflect the kinds of things that we need to do as adults. So, for example, baby rats wrestle and fight, so they do all sorts of play fighting. And the interesting thing is, if you look at, with rats, unlike children, you can actually do the experiment where you see what's the difference between the ones who get to play when they're young and the ones who don't. It isn't any one specific thing that they do, but it's how flexible and resilient they are, how good they are at changing, doing something different quickly in a new context. And that seems to be the general story. So if you just want to do one specific thing and do it well, then the best thing to do is just train a system to do that one specific thing well. But if you want to be resilient, if you want to be able to face a new problem that you've never seen before and be able to do something intelligent about it, then it turns out that playing around actually helps. There's some wonderful work by a roboticist called Hod Lipson, and he was designing a robot that had a period to begin with where it just kind of messed around. It just kind of did silly dances, basically. It played with its own body. And it turned out that the advantage of that period of play was that then if you cut off the robot's leg, it could figure out how to walk even without the leg. So a robot that was just trained to walk could be really good at walking, but if you change the situation, if you cut off a leg or you put it in a new room, it would fall apart. Whereas this robot who'd gotten the chance to play could adjust to a new circumstance, a new situation. And of course, that's what we human beings are better at doing than anything else. That's our great evolutionary niche. We're the ones who are really adapted. The way I put it sometimes is we're adapted to the unknown unknowns. The unknown unknowns, that's where we live. That's our environment. That's the environment that we do best in. And of course, there's more and more unknown unknowns as we've gone on in history.
But what's amazing is the way your work maps this out. And I get back to the Bayesian babies comment and what you're talking about, test, adjust, test, adjust. The younger we are generally, and bell curve wise, that's easier. It happens more. And then we get older and we don't test, adjust anymore. We come up with an idea and we stick with it. And if new things come into our field of vision that invalidate that direction or that idea or that hypothesis, we just keep going. We don't adjust to the new information. I don't know that I'm special in any way, but I feel like I adjust very well. And I'm constantly observing other adults that don't seem to have the ability to adjust anymore. And it always strikes me every time I see it.
Well, again, I think it's important to say, as you can probably tell from listening to me, I'm very pro 4-year-old, and I love 4-year-olds, and I love being in that wild, explore, creative side. But the truth is that there's a genuine trade-off between that and then the ability to actually get things done, to actually execute things, to actually make things happen. And to some extent, if you want to make things happen, you have to ignore a lot of distractions. You can't readjust your strategy every time there's something new. And the great challenge is, how do you go back and forth between exploring, between finding out things that are new, taking new information into account, and actually being focused enough to be able to do the thing that you want to do. One way that you could think of it is, even if you think about it from the perspective of neuroscience, it's as if there are some parts of your brain, sort of roughly speaking, in the back of your brain, that is really designed to hold lots of different possibilities, lots of different possible ways of thinking about how the world is. But the trouble is, when you act, you don't get to, sort of do 30% of one policy and 70% of another policy. You just have to choose one policy and follow through. I think the way that people solve this sometimes in computer science, the way neuroscience seems to have solved it, the way evolutionary biology seems to have solved it, is by having these kind of alternating periods, a period of play, exploration, being protected from the immediate environment, and then a period of taking the things that you've learned in that play and exploration and putting them to use. Or sometimes a division of labor of different people with different personalities and different strengths and weaknesses. So people who are really good at general exploration and people who are really good at actually implementing things and making things happen. If you are like me, if you're a scientist, for example, I think there's this constant, probably the hardest thing about being a scientist is this constant tension between, let's think of a really crazy high-risk idea, but wait a minute, there's 50 crazy high-risk ideas. How can I decide which is the one that I should actually turn into an experiment? And how can I decide how to balance the crazy high-risk ideas and the ones that are maybe not quite such high risk but are more likely to succeed? That's a very hard, challenging thing to do, but I think it's the secret of being a successful scientist, being a successful innovator.
You keep bringing up 4-year-olds. And so you're forcing me, as we have this conversation, to think the last time that I was around a 4-year-old a lot. And it was my nephew. And so, okay, in my family, there's an assortment of nephews and nieces, all teens now. So I'm having to go back a decade in time. But now, as they're all in their teens, one of them is perhaps the best athlete in the community. And he's just exceptional. And I always hear these generalizations from adults. They're like, well, he just happens to be better, this or that. But I have a very distinct memory of when this boy was 4 years old. We would go to his brother's t-ball games or whatever. His brother's a little bit older. This one little boy, who's the exceptional athlete now, at 4 years of age, I would say to him, hey, I'll give you $1 if you run around the field. It was approximately maybe 3/4 of a mile. This 4-year-old boy would run around the field perhaps 8 to 10 times during the game just to collect $1 from me. Now, what we as adults, we look back now as he's a teen and he's an exceptional athlete, and we say, oh, wow, he's just, perhaps some adults just say, well, it's just natural, whatever. And I look back to the 4-year-old time and I say, you know what? That kid had a plan. He knew what he was doing at 4 and he had a plan. Maybe he couldn't describe it. Maybe he didn't know exactly what it was, but that kid had a plan.
Well, I think there's one of the things that's interesting is you can see all of these individual differences in what kinds of things different children think are fascinating and interesting and worth exploring. And I think the secret is when you see children, the things that children get most excited about, the things that are the things that they really feel that they're exploring and that they can master. And that can be really different for different children. One of the things that's interesting, you mentioning your nephew being a teenager, one of the things that we've just started working on now is the idea that adolescence may be a kind of revived period of plasticity. So adolescence may be another time when this kind of possibility and exploration happens. And the traditional picture of adolescence has always been this very negative one. How can we keep them from getting into terrible trouble all the time? And that's a real problem. But increasingly, there's more and more evidence that adolescents are actually exploring more. And in the studies, I mentioned that we did these studies that showed that the preschoolers were actually more exploratory than the adults. Now, that was about a physical problem. That was a problem about a machine and how you put blocks on a machine to make it go. But we also did that with a social problem. Why is this person acting the way that they are? And what we discovered there was that the adolescents were actually the most flexible. So the preschoolers were very flexible. they got less flexible in school age. The adults weren't very flexible in the way they thought about why someone could do what they did. But the adolescents were. The adolescents were paying an awful lot of attention to the data rather than the priors, to put it in a Bayesian way, when the problem was about human action and social relationships. So it seems as if that might be a kind of extra burst of exploration that happens with teenagers.
I would be amiss in the limited time that I have with you still if I did not get your perspective, some greatest hits of perspectives that you might have on some issues of the day that people can perhaps relate to. Not too long ago, James Damore at Google was let go, and he had a certain perspective that he wrote down. He was let go. Could you, in a nutshell, explain his perspective and then perhaps your perspective of that perspective and how maybe we all kind of missed the real important issue in that debate?
One of the general things that happen that you come up against as a developmental psychology, one of the questions that's always seemed to be a really fundamental question is how much of anything that we do is the result of nature or nurture, or how much is it the result of genes and how much is it the result of environment. It's a very natural way of thinking about it, is to act as if, okay, there's one set of forces, nature, genes, biology, and then there's this other set of forces, nurture, parents, environment, teaching, culture. And you could kind of just treat them as if they're a vector, and you just figure out how much of one force is coming in and how much of another force is coming to shape the way that people turn out. And then you could say, okay, well, 35% of this is nature and 65 is nurture, or however the numbers would work out. That's such a natural way of thinking about it. It's very seductive. And there are even, smart popular psychologists who talk that way. But it's totally wrong from a scientific perspective. It's one of those cases where, sort of like our everyday physics turns out to be totally wrong from the perspective of scientific physics. It isn't even, people sometimes say it's not even wrong. It's just the whole wrong way of asking the question. And that's certainly true for nature and nurture, and especially for things like the sex differences that Damore was focusing on. So even the idea that there's a male brain and a female brain, or that there's a male piece that comes from nature versus nurture, just doesn't, it's the wrong categories. It's the kind of category mistake. And there are lots of examples of this. If you look at actual development, what you see is that, from the moment that there's a fertilized egg, the nature and nurture are interacting. And not only are they interacting, but they're interacting in all of these complex, nonlinear, feedback-driven kinds of ways. So it's just not a good question to ask, are women naturally more suited to tech than, naturally less suited to tech than men? That naturally just doesn't mean anything from a developmental perspective. The way I put it, Larry Summers famously got into trouble for making these kinds of arguments as an economist. And I always feel as if, my reaction to Larry Summers doing that is it's as if I went to Larry Summers and said, Larry, look, here's my idea about economics. We just need to find the right price for things. And if we just find the right price and we make sure that everyone is selling everything at the price that's the natural price for that particular commodity, then the economy will work well. Now, that's kind of not even wrong. That's just not getting the most basic things about how economics works, even though for many thousands of years, that was the natural way that people thought about economics and money. And it's kind of like that with the nature, nurture, gender, is gender, nature, or nurture kinds of disputes. It's not even the right category for thinking about the problem.
Damore put that out there, and then you hear all the reactions on assorted sides. You're saying we need to take a step back and let's think about this as a scientist, and then you're not left with such black and white answers.
I mean, it's not even just not black and white. It's that let me give you an example of one of the studies that I talked about in my column in the journal after the Damore thing came out. This is a neuroscience study. So one of the things that people talk about is, well, male brains and female brains are different. And it turns out that, in fact, there are various kinds of brain measures. And on average, you'll see a difference between men and women on these particular kinds of brain measures. And that led people to think, okay, there's a kind of naturally male brain and a naturally female brain. But it turns out that if you actually look at the correlation among those features, there isn't any correlation. So most people will score really high in the male direction on some brain parts and really high in the female direction on other brain parts. The term that neuroscientists use is that it's a kind of mosaic. There are different kinds of features, and even though when you average together large numbers of people, it might look as if there's a difference, any individual person is going to be this really complicated mosaic of different kinds of features in different brain areas. And the same thing's true about people's psychological capacities. The other thing is that there's, as we say in psychology, much more within group variance than between group variance. So there's much more difference, even if there's a little bit of difference in the overlaps, there's much more difference among different women and different men than there is between men as a group and women as a group. And again, even if you just look at the very physical fact of being biologically male or biologically female, it turns out that, you might say, well, of course, that's just determined by your genes. But it turns out actually there's a very long, complicated, bidirectional set of things that happen from the moment that you have a particular set of chromosomes to the moment that you end up with, female or male genitalia, let alone a brain that has particular characteristics. So it's taking something that's really complicated and making it simple in a way that speaks to, social categories rather than really speaks to the biology, in particular speaks to development. Another point that I think is important to make is very often people act as if something's in your brain, it must be there innately and it must be genetic. And of course, that's not true either. So even if I took a whole bunch of adult men and women and discovered that their brains were different, that's what I'd expect, given that their behaviors are different, given that their social status is different. Of course, their brains are going to be different. The question is, what happened from the time that they were a zygote that led to those differences later on?
See, what's so fun about hearing you explain that, I don't know your politics. It's not relevant to this conversation, but you are diving deep with your training, your skills, your experience, and you're laying it out there in such a way that everyone has to pay attention and say, okay, I have to consider what Allison is saying there because, perhaps I didn't know that. I have to go down that path too. And it's such a contrast to modern life where we do take things and put them into partisan silos immediately when it's just all damn complicated, isn't it?
Well, this is part of the reason why I and, other people who've been on your podcast, I think there's a real tension for scientists about when we go out into the world at large, we can't tell the whole story in all its detail and complexity in, 700 words in the Wall Street Journal or even an hour-long podcast. And I think there's a lot of back and forth about, are we oversimplifying? Can we represent the science in a really good way? But I think we're kind of, we don't have a choice. People are going to be having beliefs and making decisions based on what they think the science is, whether the scientists are conveying it properly or not. So we really have, it's not as if we don't do it, somebody else isn't going to be doing it. I think in my field of developmental psychology, that's really vivid. There's no FDA on parenting books. Anybody who wants to can go out and write a book and say, look, if you do this to your children, then they're going to come out great and go to Harvard. There's nobody to stop that except real developmental psychologists trying to say something about what the science really says.
Let's keep it at the developmental level for a moment on something relatively new, because I still recall in the summer of 1995, Netscape went public. That was kind of like the ignition switch. And now roll forward to 2018. And if I give an iPhone to a 3-year-old, their fingers start moving like freaking Mozart. Have you done work, I'm assuming you have started to investigate, what are we starting to see with the early tech in the hands of children? What are some of the big picture lessons and insights that we are learning for good and bad?
Yeah, it's a really, really interesting question. And it's funny because this is one of the examples where everybody thinks they know what the answer to that question is. Apparently, including some of the big funders for Apple. Everyone is convinced that this is terrible and that screens are going to destroy children's minds and that we need to keep them away from children and so on and so forth. It's amazing how deep the conviction is given how completely missing the data is. So, and of course, if you think about it, you said yourself, right? 1995 is Netscape. The first iPhone is now 10, 11 years ago. We're scientists. It takes us 15 years to do any kind of study, let alone try to figure out what the long-term consequences of something are going to be that only happened 10 years ago. But scientists are starting to do that. And my take is if you look at the big picture, part of what adolescents and children have always been about is about they're the ones who do the technological innovation, whether that technological innovation is putting a new design on a pot or figuring out a new way of throwing a spear or figuring out a new way of organizing your life or having a train or having a telegraph. They're the ones who are always sort of on the cutting edge of that kind of technological change. And in some sense, the function of those children is to be on the cutting edge of technological change. Now, this time may be different from all the other times, but it seems like every time that happens, the previous generation is convinced that the world is going to hell in a handbasket, and whatever this thing is. For Socrates, for example, it was actually reading. He thought that reading was a really terrible idea. It was going to mean that nobody remembered anything anymore, and it was also going to mean that people would think anything written in a book, it was true. And of course, he was right. People don't remember all of Homer anymore. People do tend to think that things that are written down are true. But on balance, we feel like the advantages of having writing and reading outweigh the disadvantages. And my guess is that's what's going to happen with the new technologies as well. We'll figure out how to both deal with the positive and the negative sides of them. And the experience for the next generation of children is going to be, the children who have been doing this from the time they were 2, is going to be really different from the kind of disruptive, distracting experience that it is for us as adults. Now, I don't know that that's true. It might be that 20 years from now, we're going to discover that this is finally the technology that's destroyed us all. But one way I put it is, if you're interested in technology that's going to destroy us all, worry about climate change. You know, there's only so many things you can worry about. Climate change, yeah, really worry about that. Don't worry about your kid and his iPhone.
But, you know, it's like, I think about you think about the tech, we can say, okay, what are all the disadvantages? I can just like sum them up in my mind. I can say, okay, maybe my eyes have gotten a little worse than they would have at this age by using the screens too much. You know, I see some adults where they've got literally a hunchback from looking at the phones. Maybe people are taking too many selfies and there's too much of that going on. But, you know, I think about from the research standpoint and the ability to connect with people, the puzzle-like thrust of all this technology, finding any piece of information, especially for those people that have the curiosity in them and they want to go check out Allison and find your site and start digging through your papers and look at all this work that this lady has done for decades before we got there. And it gives you a head start. That kind of thing. I don't know how any of us can say that's bad.
It's kind of interesting if you look at when printing first started, reading or printing or just about any kind of technological innovation. Printing is a really interesting one. There's a wonderful book about the French Revolution and the Ancien Regime. And it points out that when printing first became really widespread and you could have a lot of cheap printing, the first thing that happened was that the world was full of terrible scandal and libel and polemics and pornography and all the kind of rubbish that you see on the net now. That was what a lot of the first printed pamphlets were like. And it took a while for things to sort of sort themselves out and figure out a way for people to sort through this amazing new source of information. But again, I don't think anyone would look back and say, oh, printing, that was a really terrible idea. Being able to actually have books that were easy and cheap to produce, that was really awful and led to the end of civilization as we know it. And in fact, if you think about it, my own personal examples, if you think about the 19th century, think about the telegraph and the train. The truth is nothing technological that we've done in the last 100 years has had the same kind of impact that the telegraph and the train did. So for thousands of years, the fastest you could go was the speed of a fast horse. And then suddenly, literally, information could travel at the speed of light. That was a gigantic transformation, and it had good effects and it had bad effects. Now we look back and we think, oh, isn't that quaint and sweet and how lovely to be riding on a train? People at the time were convinced that trains were going to completely destroy the world. In a way, they did. They destroyed the world of the 18th century. And I think the new tech in some ways is going to destroy the world of the 20th century, and it's going to be up to the next generation of children to build the world of the 21st century. One way I put it is, it seems to be universally true that the day before you were born is always Eden, and the day after your children are born is Mad Max. That seems to have been true for all of history.
As we go out, let me leave with something, a great line of yours that you've used many times, which I love. And you talk about what's it like to be a baby, being in love in Paris for the first time after you've had 3 double espressos.
Why don't you let the audience know how that one came to be and what you really mean when you say that?
One of the big philosophical questions that we can ask about babies, and I talk about this a lot in my second book, The Philosophical Baby, is what's it like to be a baby? What's consciousness like in babies? And again, those philosophers who didn't think very much of babies for all those years often said, well, babies don't have very much consciousness. In fact, they did operations on babies, very young babies, without anesthesia for a while because they thought that they didn't have feeling, didn't have consciousness. Now, it's a really hard question to answer. How do you know that anybody has consciousness, let alone how a baby does? But I think when you actually look at the science, the neuroscience and the cognitive science, it suggests that we may have a really different kind of consciousness when we're babies. The way I like to put this is it's the difference between the kind of spotlight of consciousness we have as adults, where we pay attention to one thing and it's very vivid and everything else around you kind of goes dark, and thinking about the child's consciousness as being more like a lantern. It's more like something that's illuminating the whole world. We know that some of the chemicals in things like nicotine and caffeine seem to have the effect of leading to this broader plasticity, leading to a brain that changes more easily. And we know that putting yourself in the position of a baby, like going to a new place, has the same kind of effect. Consciousness gets to be much more vivid and intense, even if your practical ability to get through the world really gets damaged. So you put all that together, and being in a new state, in a new place, like being in Paris for the first time, and having all these changes to your neurotransmitters that are making them more open and plastic, that sounds a lot like being in Paris after you've had a bunch of double espressos. And as I point out, that is kind of a wonderful way to be. But it does mean that you tend to wake up at 3 o'clock in the morning crying, which may be the way it feels to be a baby.
You know, I implore the audience to check out, too. You've got a great TED Talk out there, I think 3 million plus views, but you get into this a little bit more where you've got an example and you dig in. I'm not going to ask you here now. People can go check it out. But you get into something with broccoli and crackers and babies. And I highly recommend people to go check that out for one of those aha moments of like, wow, that's a really cool revelation. Hey, listen, where's the best place we can send people to, Allison? I mean, they can quickly check out your Wikipedia link, and there are papers that go back a long time. You've got many, many books. You're easily found. Would you like to direct people to anywhere?
Well, if you go to my website, which is AllisonGopnik.com, that's got links to the books, and it's got links to my research papers and to some of the popular things like the Wall Street Journal columns and my writing in other places as well. That's probably the best kind of Gopnik Central, the best Gopnik Central place to start. And if you look, there's a section in there called Memoirs that has some stories about what my life was like growing up, and if you're interested in that as well. So that AllisonGopnik.com is probably the best place to start, and that will give you an idea. The other good place to start is my first book, The Scientist in the Crib, which was very much designed to be a kind of all-purpose introduction to this new world of developmental psychology. Or the most recent one, The Gardener and the Carpenter, which is really about these questions, these practical questions about how do we take all this new science, what does it tell us about being a parent, and both being individual parents and what we should think of as states and societies trying to make decisions about children. So those are both two good places to start.
So, you know, I asked and you said, you know, the energy, the passion from being around 4-year-olds. I'm going to have to take you at your word on that. But I have to say, you've inspired me because I like to think of myself as a pretty energetic guy. But I say to myself now, my gosh, as I move forward in the next bunch of decades, assuming I've got those decades, why not stay energized and excited, right? All this boring, placid stuff, that's no fun. You want to have the energy every morning. Do you ever wake up in a morning not excited? There is no way the person that I'm talking to right now ever wakes up and is not excited. Is that true?
I can tell you one thing. I have 3 grandchildren who are the complete joy of my life. And my one practical piece of advice to people is skip the children, just go straight to the grandchildren. I take care of them about once a week. In the morning, when those little faces show up, it's the most exciting, wonderful, great thing in the entire world. By about 9 o'clock, when they're ready to go to sleep, I am really worn out. So if you saw me at the end of a full day of engaging with a 6-year-old, a 4-year-old, and a 2-year-old, there are certainly moments when all that thinking and seeing and engaging in the world can wear you out. But it's well worth it for the day of inspiration. And it is actually true that, if I think about that day versus the working faculty meeting going, filling out the forms, answering emails kinds of days, there's no question that feels like a much better day to be human on.
Allison, I appreciate you taking the time today. Great insights. I could probably pick your mind for hours, but I appreciate you taking the time.
Thanks. Happy to talk to you.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.